how the markets are reacting to stimulus negotiations and the upcoming election. Let's bring in our panel. Joining me now, John Lynch, CIO of Comerica Asset Management, and Michael Jones, Caravel Concepts Chairman and CEO. Gentlemen, it's good to have you on today. We're looking at the S&P 500 now less than 2% away from a record high. John, so my first question to you, why do you think the market is suddenly less concerned about a stimulus bill being reached before the election?
It's kind of concerning. You've seen a market today moving so quickly on, the growth sector in particular doing so well. This market's rallying on free money, optimism for potential further stimulus, but we really have to be concerned about valuations when we're well above 3,500 on the S&P 500, I believe.
Michael, just 2 weeks ago, strategists were forecasting that a blue wave would be the worst outcome for the equity market. But with today's rally and that coinciding with the latest poll suggesting Biden is widening his lead, why do you think the narrative has changed?
Well, I think for one thing, I think investors have looked back at the track record of what has happened historically when capital gains have gone up, because that's the obvious big downside for equity markets if there is a blue wave, an increase in capital gains taxes. And historically, the 87 and the 2013 increases in capital gains were associated with a big uptrend in equities. So, I think people have sort of lost some of their fear of the blue wave. But the challenge is, and this is, I echo John's concerns, the challenge is that investors seem to have lost their fear of everything. They seem to be pricing markets as if we're going to get a big stimulus before the election. We're going to get the Fed cranking up the printing presses, and the election's going to be smooth as silk without any controversy. That seems to be setting us up for disappointment on one or more fronts.
John, do you think the market is becoming immune to higher taxes, or is it this notion that the Fed will be there to provide that support, whether a stimulus bill gets passed or not?
Well, stock valuation is always about, in our estimation, earnings and interest rates, and we certainly have confidence that the Fed is going to be a tailwind. But as Michael talked about capital gains taxes, we also have to factor in the corporate tax rate. Corporate profits next year are projected to be at record levels. Yet if the corporate tax rate goes from 21% to 28%, as the Biden campaign has proposed, that could knock as much as 10 or 12% off corporate profitability. So when you have these liquidity-fueled days as today, that makes future gains suspect.
Michael, have you priced in a higher tax rate into your portfolio? Have you made changes, perhaps going for more domestically focused stocks, if you will, looking at the small cap index, already up 8% so far this month?
So I think the big issue that in terms of concern about taxes and earnings and so forth, you kind of have to divide the world into pre-election and post-election. So the post-election world, as I look forward into 2021, I think John's points about corporate taxes, absolutely valid. But I think those concerns can be overwhelmed when you get another COVID-19 stimulus bill, you get the Fed cranking up another $1 trillion or $2 trillion of liquidity injected into financial markets. That, to me, is far more powerful than the headwind of corporate tax increases. The challenge that I see is I'm not sure any of that happens until we get through the election. And if we go into the election, and both President Trump and Vice President Biden have said they will not necessarily just accept what happens on November 3rd. There could be a protracted legal dispute. And if we don't have COVID-19 stimulus, if we don't have the Fed cranking up the printing presses before that kind of political uncertainty, that's where I think we're vulnerable for a pullback, and potentially an ugly one if the controversy over the election is significant enough.
John, last question to you. Technology leading the way here today with Facebook, Apple, Amazon up 5 to 6%. I mean, this idea that if the Democrats get more seats in the Senate, and this notion that the tech industry should brace for more regulation, how could that cloud the outlook for these large technology companies?
Well, for the large tech companies, it certainly could cloud. And that's why I think you'll have to separate within technology who are the beneficiaries of cyclicality or growth. And if you think about separating, for example, semiconductors versus software, you may have an opportunity there. But the potential for an increased stimulus package could also bode well. An infrastructure package, rather, early next year could bode well for a broadening of participation in the markets, looking at industrials, financial, and potentially consumer discretionary as well.
Yeah, and we're starting to see that signs of broadening out with Caterpillar now less than 5% from its record high. So it's a good point there, John. And Michael, thank you for joining us today, John Lynch and Michael Jones.